the declining purchasing power of the dollar, which, we're talking about when we look at the gold price, or, if you like, the dollar priced in gold. What gives the dollar its value? I mean, we're talking about bits of paper or units on in some sort of electronic account. It's just faith in it. It's just faith. That's all it is. What gives gold its value? Well, you can actually hold it, and it's legal money. We all know governments lie through their teeth, so why should we stop believing the People's Bank of China? I mean, the fact of the matter is that, and this is fact. Long before the Chinese people were allowed by the government to accumulate physical gold, the People's Bank of China was accumulating gold for the state, and it was siphoning this off into various state accounts to hide the degree of gold accumulation. They were appointed to do this by law, and I've got an English copy of this law, back in 1983. And it wasn't until 2002 that they suddenly turned around and said, okay, we'll let the people buy gold, and we will set up the Shanghai Gold Exchange, which is controlled by the People's Bank, incidentally, in order to facilitate them to do this. And then started advertising to people, rush out and buy gold. This was the Chinese government advertising, the merits of owning gold and all the rest of it. So, the state, I reckon that by the time 2002 arrived, and remember, we're looking at a market which was a bear market in gold. Gold was being, rejected by the Western capitalist fiat money system, so much so that it went down to around about $250, from sort of a very brief peak at over $800. And it was during that massive bear market, when everybody in the West was getting rid of gold, that China was quietly sort of buying it in. I mean, they were the hidden buyer of gold. And they've accumulated it. I reckon that by then they'd probably accumulated something like 20,000 tons at contemporary prices. It just made an awful lot of sense because, China wasn't exposed to Keynesian economics. Therefore they understood that gold is true money. What do you do when you're, getting all this foreign inward investment in the sort of 80s and going into the 90s, and then your huge export earnings, and you're controlling the entire foreign exchange situation because you're not allowing ordinary Chinese people to go out and buy foreign currencies for whatever reason. But given that that is the case, what do? You take those flows and you look at something like, well, it makes sense to put something like 10, 15% of those flows into gold, and that gives you somewhere between 20 and 30,000 tons at contemporary prices. Now, they won't have stopped there, of course. I'm sure that they've continued to accumulate gold from time to time. China is a savings-driven economy. There is absolutely massive quantities of currency which is seeking an investment home, and that is around about 6 trillion a year. And I would have thought that gold and silver would be the most effective hedge for Mrs. Wong or whatever living in one of those mega cities in China. So, that I think is the real driver. I mean, I forget what the People's Bank is doing. And anyway, as I said, basically the People's Bank is trying to get rid of dollars, and that's actually what's driving its foreign exchange policy.
Governments, including China's, often engage in strategic deception, especially regarding their gold reserves. The People's Bank of China, PBOC, has been a prime example, accumulating gold quietly and through various state mechanisms long before Chinese citizens were allowed to purchase gold themselves. This clandestine approach was formalized by a legal mandate established in 1983, tasking the PBOC with the accumulation of gold on behalf of the state. The true extent of these reserves was hidden, dispersed across various state accounts to obscure the actual volume of gold holdings from the public and international observers. The decision to allow Chinese citizens to purchase gold came in 2002, during a time when the gold market was experiencing a significant downturn. The metal's price had dropped to around $250 per ounce from a peak of over $800. This bearish phase was a perfect opportunity for China to increase its gold holdings without attracting much attention. By promoting gold ownership domestically, the Chinese government also aimed to develop a robust internal market that would support the metal's price. This strategic move was not just about encouraging savings, but also about creating a hedge against the potential devaluation of foreign currencies, particularly the US dollar. The narrative surrounding the PBOC's gold purchases is often misunderstood. While the headlines may suggest that China is aggressively buying gold, the underlying reality is that these purchases are part of a broader strategy to reduce reliance on the US dollar. The PBOC's actions are essentially a hedge against the depreciation of dollar-denominated reserves. As the purchasing power of the dollar declines, the value of holding these reserves diminishes, prompting a shift towards more stable assets like gold. This strategy is not just about diversifying reserves, but also about protecting national wealth from potential geopolitical and economic disruptions. This perspective flips the conventional understanding of gold price movements. The increase in gold prices is not necessarily a bullish indicator for the metal itself, but rather a bearish indicator for fiat currencies, especially the dollar. Central banks, including the PBOC, are signaling their lack of confidence in the long-term viability of fiat currency systems by increasing their gold reserves. This is a clear indication that these institutions see gold as a safer store of value compared to increasingly unstable fiat currencies. This shift is significant as it reflects a broader trend among global financial institutions to seek security in tangible assets. Fiat currencies, by their nature, are not backed by physical commodities. They derive their value from government decree and the public's trust in the issuing authority. However, this trust is fragile and can erode quickly in the face of economic instability or mismanagement. The recent era of quantitative easing and expansive monetary policies has exacerbated the risks associated with fiat currencies. As central banks continue to pump liquidity into the markets, the value of money decreases, leading to inflation and, in some cases, hyperinflation. Gold and silver, in contrast, do not suffer from these vulnerabilities. Their value is intrinsic, rooted in their physical properties and the difficulty of extraction. This makes them ideal hedges against inflation and currency devaluation. The growing interest in these metals is not just from individual investors, but also from institutional players, including sovereign wealth funds and central banks. These entities are increasingly aware of the limitations and risks of fiat currencies and are turning to precious metals as a form of financial insurance. The price of gold is often viewed as a barometer for the health of the global financial system. A rising gold price typically signals underlying weaknesses in fiat currencies and growing distrust in the financial system. This is why the manipulation of gold prices has been a common practice among central banks and major financial institutions. By keeping gold prices artificially low, these entities can maintain an illusion of economic stability and currency strength. However, the sustainability of this manipulation is questionable. The physical market for gold, driven by real-world demand, cannot be suppressed indefinitely by paper trading on exchanges like COMEX. As more investors and central banks seek physical gold to hedge against economic uncertainties, the demand will eventually outstrip supply, leading to a significant price correction. This potential revaluation is a looming threat that could trigger a massive shift in global wealth, particularly affecting those who have relied heavily on fiat currencies.
Well, I think there's a misunderstanding about what $2,400 gold price really means. I mean, we can illustrate this with the actions of the People's Bank of China. Read all the headlines. The People's Bank of China has been buying gold. That's actually got it completely the wrong way around. What the People's Bank of China has been doing is selling dollars. The People's Bank of China is in effect saying we think the purchasing power of dollars in our reserves is going down. Now, there are various reasons why that might be the case, but it is the purchasing power of the dollar falling, not the price of gold rising. And this is where everybody gets gold wrong, and particularly the establishment, the bullion banks in London, the swaps on COMEX, all these guys, their only experience has been in a fiat currency environment since particularly the mid-1980s, when everything was financialized with Big Bang in London and so on and so forth. So what they're doing is they're trading something, they account in dollars or they account in euros or pounds or whatever. So their comparison is profits and losses measured in the fiat currencies. But actually in monetary terms, because gold is legal money without counterparty risk everywhere, and euro and mine currency are not counterparty risk free, and they're not used everywhere, you can see where the risk is. The risk is in the fiat currencies. So, on that basis, what we're seeing with People's Bank of China and also all the other central banks who are doing exactly the same thing is they're sending a very clear signal that they're seeing the purchasing power of fiat currencies declining. Well, I mean, if you look at the charts, this is what everybody does when they don't understand what's going on. Look at the charts, and you can see there's been a long consolidation period, and so the breakout was bound to be, pretty dramatic. But dramatic initially, and again, talking purely in charting terms, it's the start of a new bull phase. So that's where we are. I think what we've seen sort of part one of the new bull phase, and that was a run up to 24.45 or whatever it got to. We're now consolidating that, and we've been consolidating that for the last 2 months or so, 2 or 3 months, and at some stage that consolidation will end and off we go. But as I say, what it's actually about is the declining purchasing power of the dollar, which we're talking about when we look at the gold price, or if you like, the dollar priced in gold. What gives the dollar its value? I mean, we're talking about bits of paper or units on in some sort of electronic account. It's just faith in it. It's just faith. That's all it is. What gives gold its value? Well, you can actually hold it, and it's legal money. This is the point. I remember when we were, when you very kindly invited me to talk in Frankfurt. I made this point to the invited audience, and I don't think people understand this point enough. So gold will continue to appear to rise, but actually what's happening is that its fiat currency is falling. It's estimated that Chinese households save 35% of their income. Now, 35% of their income is around about $6 trillion on Chinese GDP. So $6 trillion, where does it go? Property? Yesterday's story. Stock market? Not really. It goes into bank accounts, and it goes into gold. And I think it's increasingly going to go into gold and also silver, because Chinese individuals can't go and buy foreign currencies or foreign stocks or anything like that. They don't have these avenues which we have become accustomed to, whether the avenues are good or bad.
The suppression of silver prices like gold is becoming increasingly difficult to maintain. The industrial demand for silver is rising, driven by advancements in technology and the push towards greener energy solutions. At the same time, the metal's monetary properties are gaining recognition, especially in countries looking to diversify their reserves away from fiat currencies. As these dual demands continue to grow, the supply of silver will likely tighten, pushing prices higher. The current low prices present an opportunity for savvy investors to acquire silver before the market fully recognizes its value. The accumulation of gold and silver by central banks and other large investors is not just a financial strategy. It is a reflection of broader economic and geopolitical trends. This behavior suggests a lack of confidence in the current monetary system and a preparation for potential systemic shocks. As the global economy becomes more uncertain due to factors like trade wars, geopolitical tensions, and the possibility of a new financial crisis, the role of gold and silver as safe haven assets is becoming increasingly important. For individual investors, the lesson is clear. Incorporating gold and silver into a diversified portfolio can provide significant benefits. These metals offer protection against a wide range of financial risks, including inflation, currency devaluation, and market volatility. While the short-term price movements of gold and silver can be unpredictable, their long-term value as stores of wealth is well established. The actions of central banks and large institutional investors only reinforce this perspective, highlighting the strategic importance of these assets. As we look toward the future, the landscape of gold and silver markets is poised for a dramatic transformation. The increasing adoption of digital currencies and blockchain technology is set to revolutionize the trading of these precious metals. These technologies offer greater transparency and reduce the ability of centralized institutions to manipulate prices. As digital currencies become more integrated into the global financial system, they could serve as a new pricing mechanism for gold and silver, allowing for a more accurate reflection of their true market value. Furthermore, the rising demand for ESG-compliant investments is likely to impact the mining and production of precious metals. Investors are becoming more conscious of the environmental and social implications of their investments. As a result, mining companies may face increased pressure to adopt sustainable practices, which could limit supply and drive up costs. This shift towards more responsible mining practices could also make gold and silver more attractive to ESG-focused investors, further increasing demand. The geopolitical landscape is another critical factor influencing the future of gold and silver markets. As global power dynamics shift, countries are increasingly seeking to reduce their dependence on the US dollar. This de-dollarization trend is driving nations to diversify their reserves, with gold being a key component of this strategy. The ongoing tensions between major powers, such as the US, China, and Russia, are exacerbating this trend as countries seek to insulate themselves from economic sanctions and other financial pressures. In this context, gold and silver serve as both financial assets and geopolitical tools. By accumulating these metals, countries can strengthen their economic sovereignty and reduce their vulnerability to external pressures. This strategic accumulation is likely to continue, further supporting the prices of gold and silver in the long term. In conclusion, the ongoing accumulation of gold and silver by central banks and other major players highlights a fundamental shift in the global financial landscape. The manipulation of these markets by commercial banks and the broader financial system is a reality that informed investors must navigate. While this manipulation can be frustrating, understanding it provides a strategic advantage. As the global financial system faces increasing strains, the true value of these precious metals will become more apparent. For investors, the key takeaway is the importance of patience and a long-term perspective. Gold and silver are not just commodities. They are timeless stores of value with a proven history of providing financial security. As the world transitions towards a new financial paradigm, these metals will likely play a critical role in preserving wealth and ensuring economic stability. Thank you for joining us in this exploration of the complexities surrounding the gold and silver markets. Stay tuned for more insights, and remember, in the intricate game of financial markets, knowledge is your most valuable asset. Whether you are a seasoned investor or new to the world of precious metals, understanding the dynamics at play will help you navigate the challenges and opportunities ahead. Let's continue to explore this fascinating landscape together, ensuring a prosperous and secure financial future.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.